There was a time when U.S. farmers fed the world. China couldn't get enough of American soybeans until one decision changed everything. Now grain silos sit overflowing in Illinois. Soybeans rot unsold in North Dakota. And across the Atlantic, Brazil's ports are booming with Chinese cargo. What happened wasn't just a trade shift, it was a global realignment. And the U.S. didn't just lose a customer. It may have lost control of something far bigger: food power. Welcome to Geo Capitalist, where we decode global wealth, one power shift at a time. If you're new here, hit subscribe. We connect the dots behind the headlines, and today, we're tracing how China quietly replaced U.S. farmers with Brazil. Let's get into it. In the early 2000s, few economic relationships grew faster than U.S. agriculture and Chinese demand. As China's population urbanized and incomes rose, so did the demand for protein, and with it, soybeans to feed a booming livestock industry. The U.S., with its vast farmland, industrial-scale production, and global shipping infrastructure, stepped up. American farmers exported over 30 million tons of soybeans annually to China by 2016, making China their top buyer by a wide margin. Entire counties in the Midwest depended on this export link. It wasn't just commerce, it was a pipeline of economic stability for rural America. The system seemed unshakable, but underneath it was fragile because it hinged on diplomatic goodwill, and in 2018, that goodwill snapped. In 2018, the U.S. imposed tariffs on Chinese goods in an effort to correct trade imbalances. China retaliated, targeting agriculture, especially soybeans. Practically overnight, Chinese importers canceled orders from U.S. suppliers. The result? A 75% plunge in U.S. soybean exports to China within months. Farmers, caught in the crossfire, watched harvests pile up with nowhere to go. The U.S. government responded with billions in bailout packages. But markets don't wait, and China didn't either. Beijing immediately turned to Brazil, the world's second-largest soybean producer, with a currency advantage and rapidly expanding production. In Mato Grosso, Brazil's soybean heartland, planting surged. Export terminals adjusted, and Chinese buyers flooded in. By 2019, Brazil had overtaken the U.S. as China's #1 supplier. What began as a temporary trade dispute became a structural shift. The U.S. had fired a shot. But China had changed partners. Brazil didn't just fill the gap, it redesigned the system. With China's backing, Brazil upgraded its agricultural logistics. The port of Santos expanded its grain terminals, rail links were modernized, and Chinese state-owned companies signed long-term contracts with Brazilian producers. The Brazilian real, trading at a discount to the dollar, made soybeans cheaper and more attractive. Unlike the U.S., Brazil didn't demand geopolitical alignment. It just sold. Production skyrocketed. By 2023, Brazil exported over 60 million tons of soybeans to China, nearly double the U.S. total. This wasn't just about volume. Brazil built reliability, and in the background, China quietly invested in the country's agricultural ecosystem, funding roads, ports, and even agri-fintech startups. A new axis had formed. Brazil grows, China buys, and the dollar is optional. This was a new kind of trade empire, one that didn't run through Washington. While Brazilian exports surged, American farmers faced a harsh and humiliating reality. Soybeans, once destined for Chinese ports, sat unsold in massive grain bins across the Midwest. In North Dakota, farmers reported grain literally spoiling in storage due to backlogged logistics and canceled contracts. In Iowa, storage facilities overflowed to the point where temporary silage bags were deployed in open fields, just to buy time. In Illinois, headlines warned of beans with nowhere to go, as the region braced for yet another harvest with no guaranteed market. The situation wasn't just inconvenient, it was demoralizing. Many farmers had pre-financed their planting season based on expected Chinese demand. When that demand vanished overnight, debts mounted quickly. The federal government responded with emergency subsidies, over $28 billion in aid between 2018 and 2020, but these payments functioned more like financial painkillers than cures. They may have padded income statements in the short term, but they did nothing to rebuild lost markets, fix broken trust, or ease the long-term volatility farmers now faced. Meanwhile, input costs refused to stay still. Fertilizer prices spiked by over 70%. Machinery replacement cycles stretched out, insurance premiums rose, and worst of all, the buyers weren't calling. From 2018 to 2021, U.S. soybean exports to China dropped by nearly half. Even when Beijing cautiously resumed purchases in 2022 and 2023, it did so selectively, and often only when Brazilian harvests dipped due to weather. The psychological toll was profound. Generations of family farmers who believed they were feeding the world found themselves isolated, uncertain, and angry, not at any one actor, but at a system that had quietly shifted beneath their feet. Trade talks were no longer about agriculture. They were about semiconductors, rare earths, and intellectual property. Agriculture, once a proud pillar of American economic diplomacy, was now collateral. The soybeans kept growing. The fields remained full. But the future? It was being traded elsewhere. In early 2023, a quiet but historic agreement was signed. China and Brazil would begin settling bilateral trade, including soybean contracts in yuan and reais, not U.S. dollars. For decades, agricultural commodities had been dollar-denominated. This shift signaled something deeper, a challenge to dollar dominance in trade. Brazil's central bank created infrastructure to support yuan clearing, and Chinese state banks expanded their presence in São Paulo. While initial volumes were small, the symbolism was massive. China's largest food source and Latin America's largest economy had sidestepped the dollar. It wasn't just about convenience, it was strategic insulation from U.S. financial influence. And for Brazil, it offered leverage. The more trade happened outside the dollar, the more Brazil's central bank could negotiate on its own terms. In short, China didn't just change soybean suppliers, it changed the currency they paid with. Beneath the surface of U.S. prosperity, something is quietly cracking. And it's not being tracked on Wall Street. Farm debt hit a staggering $500 billion in 2023, the highest on record. And behind that number is a painful story of decline. Chapter 12. Bankruptcy filings, a category created specifically for family farms, surged across the Midwest. From Kansas to Wisconsin, operations that had survived droughts, recessions, and generational turnover are now being priced out not by nature, but by economics. Input costs are breaking budgets. Fertilizer costs nearly doubled between 2020 and 2022, driven by global energy volatility. Diesel prices fluctuated wildly. Equipment, often financed with multi-year loans, became harder to replace or repair. Seed prices rose. Crop insurance premiums jumped. Meanwhile, export volumes, particularly to China, failed to recover to pre-trade war levels. Even as global food demand rises, U.S. farmers are capturing a smaller share of it. The result? A painful transformation of land ownership. In states like Nebraska, Missouri, and parts of Ohio, Farmland is increasingly purchased by private equity funds, foreign investors, and large agribusinesses. These entities are less interested in sustaining family legacies and more focused on scale, automation, and profit margins. For smaller farms, this creates a death spiral: rising costs, falling margins, and zero leverage at the negotiating table. The cultural shift is just as stark. The American farmer, once mythologized as the bedrock of national independence, is being replaced by spreadsheets, subsidiaries, and buyout clauses. Rural communities shrink, schools consolidate, and local economies hollow out. And the headlines? They're distracted. While the media focuses on tech IPOs and AI breakthroughs, one of America's most foundational industries is collapsing in silence. China's soybean switch wasn't a blip. It was a signal that the world is diversifying away from U.S. agriculture, and the American farm is no longer untouchable. The system wasn't just disrupted, it was exposed. And for many, it may already be too late. This wasn't a short-term fix. China didn't just move away from the U.S., it chose Brazil as a permanent pillar of its food security. Why? First, cost. Brazil's soybeans are consistently cheaper thanks to currency and lower labor costs. Second, alignment. Brazil is a BRICS ally, geopolitically non-threatening, and unlikely to sanction China in future disputes. Third, scalability. Brazil has millions of hectares still available for agricultural expansion. And fourth, silence. Unlike U.S. politicians, Brazil doesn't use trade deals as moral battlegrounds. That's attractive to Beijing. Add to this the Belt and Road-style investments flowing into Brazil's infrastructure, and you get a deeply integrated supply chain. China isn't just buying from Brazil. It's helping shape its economy. This is agricultural diplomacy, and it's working. Washington framed it as a trade war. But to China, it was always about food leverage. And that leverage is now locked in. Soybeans were the spark, but the fire is much bigger. This isn't just about agriculture. It's about who controls the arteries of global trade in the decades ahead. China's strategic moves in commodities now extend well beyond oil and metals. It is quietly laying claim to the global food supply, arguably the most essential and geopolitically unchallenged resource of all. And it's doing so by aligning with nations willing to decouple from U.S.-led economic structures. Brazil was the prototype, but not the last. In the Middle East, yuan-denominated contracts are gaining traction, especially for agri-imports in countries like the UAE and Saudi Arabia. Across Africa, China is funding irrigation projects and rail lines in exchange for crop rights and agri-export guarantees. In Southeast Asia, nations like Indonesia and Vietnam are signing long-term supply contracts with Chinese state-owned food distributors, some bypassing Western intermediaries altogether. And then there's BRICS. What began as a diplomatic acronym is rapidly evolving into a parallel trade ecosystem, complete with payment platforms, currency swap lines, and infrastructure banks, all designed to reduce dependency on the dollar and redirect value chains away from Western oversight. China isn't forcing countries to abandon the U.S. It's offering them an alternative, often more predictable, less politicized, and more infrastructure-friendly. Meanwhile, the U.S. is watching decades of hard-won trust in global markets erode. Trade partners remember the tariffs, the abrupt policy reversals, the sanctions, and while U.S. farmers still grow some of the world's best crops, buyers are thinking differently now about risk, reliability, and independence. What began as a tariff policy to protect American farmers now looks, in hindsight, like a historic own goal. one that accelerated the very diversification Washington feared. The soybeans may still grow, the fields may stay full, but the buyers, the currencies, and the future, they're shifting south and east. The real game isn't agriculture, it's economic alignment. And China isn't just playing, it's building the board. If you found this breakdown valuable, watch our next video. It connects directly to what's unfolding. And don't forget to subscribe. Your support helps us decode these global shifts without compromise. Let us know in the comments, did China outmaneuver the US, or was this inevitable? Either way, the world is watching. This was rotting in the US, rich in Brazil, China's soybean switch explained. Thanks for watching, and we'll see you in the next video.